Awesome, guys. Thanks again. This is the second time we've kind of tried a new format, had some Q&A, trying to bring some more value to all you guys are here. So thanks everyone who made it out. And thanks for everyone who is joining us online, whether you're watching now or in the future. We have Mark Kappelman with us with realestateaccounting.co. He's the co-founder, and he's also a developer here on the northwest side of Chicago. I met Mark through GoBundance, which is a group, kind of a mastermind group where everyone's just really actively trying to help each other out to kind of expand and grow, which is kind of what we're all trying to do here at these networking events. So just super excited to have Mark here. Mark, maybe you can kind of give us a little more background about you, and then we can dive into some real estate accounting questions. So if any of you guys here in person have any questions, please write them down, and or you can send them to the chat if you're watching virtually.
Yeah, thanks. Hey guys, nice to meet you. Mark Kappelman. Yeah, so I got into real estate in 2013. Before that, I was working at PwC doing accounting consulting. So got an accounting degree, master's of accounting, kind of went that route. Then I bought a house in 2013. My wife and I flipped it. We made like 30 grand. I'd never had that much money at one time in my life. And I was like, wow, okay, I need to. So then I left PwC, started doing more rehabbing, got so busy that I outsourced my own accounting for my real estate, because I was still trying to work at this tech company, flip real estate. It came back, the accounting was terrible. I didn't understand anything about real estate, what to capitalize, what to expense, NOI, all these things that I was taking for granted. And I probably had higher standards because I'm a CPA. So then I just realized, so I outsourced him twice, went really bad. Then I had the idea of there's got to be somebody that's doing this, that's focused and just focused on real estate. And I couldn't find that. And that's kind of how the business idea for the accounting firm came together. So, you know, fast forward now on the real estate side, so kind of from 13 to 22, I guess, we've amassed about 40 units between Chicago and Florida, and then have a couple single family homes. And then we started the accounting business officially like 3 years ago, and we're up to 50 people now and kind of scaling that out, and work primarily with property managers. So I was kind of explaining, you know, any property managers that's managing at least 100 units, that's kind of our sweet spot. But we have guys that are managing 2,000. Yeah, if you've ever rented at an apartment building, a big apartment building, they're probably using one of a few softwares: Appfolio, Yardi, Buildium. I see people nodding their heads. So big property managers, you know, they have a choice. Somebody's got to do the accounting. So they either hire it in-house or they outsource it. In the downturn, ironically, we had started the business before the pandemic. So we had started that before, and we actually got an influx of business because a lot of people cut headcount, realize you still got to do the accounting because you still have to keep up with it. You got to pay your owners their owner distributions. If you guys own any properties with third-party managers, you get a distribution every month. Well, we're on the other side of it, calculating that payable, publishing the statement to your portal. So that's what we do. We're just outsourced accountants for property managers, and then work with syndicators and developers as well.
Awesome.
Hopefully that was helpful.
That's perfect.
Cool.
So I'm going to start out with a couple questions, and then I guess if you guys in the audience have any specific questions, if you just kind of want to raise your hand, flag me, yell your question out, I'll repeat it here so everyone else can hear it, and then we can kind of see where the conversation takes us. But I want to start super simple. A lot of people are here trying to get started, figuring out what the right next steps are. So I want to talk a little bit about entity structure. When do I need an entity from an accounting perspective and like the legal perspective? Not asking about the legal perspective, but like there's always tons of confusion about, should I do an S Corp? Should I file as a C Corp, LLC? When do I need to open up an entity? Should I be flipping houses in this type of entity? Could you just kind of like dive into that? It's a pretty general question, but I think you can snowball.
I can simplify it really, really closely, or really simply. If you're flipping actively, you need an LLC, just period. You should not be flipping properties outside of an LLC, in my opinion. I feel very strongly about that because you want that legal protection. Something's going to go bad. Somebody gets hurt. So the first thing I do, anytime I've ever bought a deal ever, before we close, we open the LLC. It's really easy to do. You can do it online now on state of Illinois or whatever very quickly. Get your EIN because you need a IRS number. You do that right online. That takes 5 minutes, literally. So then once you've got an LLC, then you have two options. Standard LLC is taxed as a partnership. So you're asking about S Corp. So LLC is the legal, and then you got to figure out how you want to tax it. If it's active flipping, make it an S Corp. If it's long-term passive rental, make it a partnership. So LLC, if you ever open an LLC, its standard is it's taxed as a partnership. So the only way that you get it to be an S Corp is you make this S election. Try to keep it simple why you do an S Corp. The reason you do an S Corp is because within a LLC taxed as a partnership, 100% of the profits are subject to self-employment tax, okay? Which is about 15%. So within an LLC taxed as a partnership, if you're doing active income, 100% of it's taxed at self-employment tax. If you do an LLC tax as an S Corp, you can pay yourself a salary. So if you generate 300 grand of profit, just throwing out numbers, you generate 300 grand of profit, you can pay yourself $100,000 salary. Now you're only paying self-employment taxes on 100,000, and you do not pay self-employment on the other 200,000. And 200,000 times 15% is $30,000. So this is real money. When you're not making a lot of money, the dollars are kind of small. But once you start scaling, like my accounting firm is taxed as an S Corp. We're an LLC taxed as an S Corp because that's active income. We pay ourselves salaries and we distribute a lot more than we pay ourselves. And we're only paying self-employment tax on what we pay ourselves. Every, CPA firm, they're all taxed as S Corps. But I would do the same thing so you're flipping entities. But any LLC that you are buying just to hold a passive real estate, so we have a 6-unit building on Diversity in Wolf or Diversity in Ridgeway. That's an 8-unit building. It's just held in a regular LLC because it's just passive income. That's not active income. Generally speaking, real estate is just passive.
Sure.
Passive activity. If you're a flipper, that's considered active income.
What if I'm wholesaling? What's the best structure to?
I'd be S Corp. That's active income.
Okay. Interesting. Any other specific questions? Kind of entity structure to anyone setting up an entity? There we go. Yell it out.
For Airbnb, depending on how long your tenants are, is that active or passive?
So yeah, Airbnb is actually reported on Schedule C. So that is active income. It's not a passive rental activity, unfortunately. I used to think it was. And then I talked to, even though I'm a CPA, I'm not a tax guy. When you go into accounting, you're either a tax guy or you're everything else. And I went into everything else. But I know a lot about tax. So, because I own a 3-unit Airbnb building in Tampa.
Okay.
And so that gets reported on Schedule C, which is active income.
So LLC tax as an S Corp.
Yes.
Okay.
Not like that. Not that, because that's. Yeah, the Airbnb that's actually, I own that one personally, and that's actually in my personal name. Ironically, we haven't actually, because they wouldn't let us close an LLC, so I guess I'm going against. I had to close in my personal name on that one because we couldn't get the right loan.
Yeah, sure.
But generally speaking, flipping, make it an S Corp. Passive, yeah, go ahead.
What if you have a situation where you're only Airbnb and like to piggyback off that, you're only using one unit to Airbnb and the other two are just a regular renter, passive?
So the question was.
Yeah, that's a good question. I don't know. I don't know that scenario. I wish. I don't know the answer. I haven't done that. Okay. Yeah.
So just so everyone online heard, so the question was whether or not you should, if you have 1 unit or 2 flat and you rent out 1 unit as an Airbnb, what's the right way to tax it? We're not exactly sure, but Michael said there's a certain threshold that if your Airbnb is under that income amount, you may not need to report it. They won't send you tax. Yeah, I think you are right.
But my gut on that is just a standard LLC. If 2 of the 3, if the majority of the units are passive, just straight rent, standard monthly renters, I would put it in an LLC tax as a partnership. I think there was a question right here.
So if you have a standard LLC, just partnership, are you able to convert that to an S corp?
Yep,
or do you have to
yep.
start a new one?
Nope.
So the question was, if you have a standard LLC, can you convert that to an S corp?
I want to, I don't have all these forms. It's like 2553, but you just S election form. If you just Google S election form, it's really simple. You just submit it to the IRS and say, hey, I want this to now be taxed as an S corp.
And follow-up question, does your firm, do you deal with smaller investors? Like maybe you only have a handful of properties or whatever, but where you only focus on large?
We'll look everything on a case by case basis. I would say it's more larger, but we work with some smaller guys, but not many.
Okay.
Yeah.
So I am currently trying to house hack, and I'm wondering, like I said, a two-part question. The first part is, as I understand it, you can't have an LLC if you're living there. And then the second part is, if we leave, should we put it in an LLC?
Okay, so the question was, you're trying to house hack and you're wondering whether or not you should or can put the property in an LLC. And what was the second part?
While we live there. And then
While we
after
live there?
leave, should we put it
And then after you live there, should you quick claim it into an LLC or something after that?
Definitely once you leave, I would. The trick really is on your personal residence, it's usually the lender that's like, I'm not lending to an LLC that owns it. I want you to be on the hook because if this goes bad, I'm coming to you and foreclosing on you and not this LLC that might not have any assets. Now, have I closed on a loan in my personal name before and quick claimed it to an LLC after the fact? Yes. Are you supposed to do that? I don't think so. But I own a few single family homes, one in Tennessee, one in Florida, and one in Ohio. And they're not giving me 20% or 80% loan to value on an LLC. And all of a sudden they want 30% down and that becomes less attractive, right? So definitely once you move out, I would put it in an LLC, but just know that the bank documents probably say you're not supposed to do that.
Bernie, way in the back.
If the LLC be a series, example, can each house have its own, or if you have the number one LLC, and then the series of each of each company.
Yeah, I use series LLCs. You don't really need to use them as much anymore. The reason I used to use them before was because it used to, in Illinois, if you're doing Illinois series LLCs, it was really expensive to open a new LLC and it was cheap if you did series. For whatever reason, Illinois dropped all the costs of LLC filings. God knows why, because everything here in the state is expensive in my opinion, but they dropped all those costs. So now I don't do series. Not to mention the fact is a lot of other states don't even recognize them. So I couldn't even get a business bank account with Chase because it was a series LLC. They're like, we don't work with those. So I don't even advise those anymore because it's pretty cheap to open the LLCs now. They dropped the cost. They're like by 3X or 4X.
Yeah.
Man, so yeah, just so everyone knows, right, series LLC was basically a specific structure that Illinois had where you can open a parent company and then
Have like subs, even though they're standalone companies and you could just, it was just cheaper. I don't really know why. And now I think they just got rid of that. There's only a couple states that have series, but I don't do them anymore because it doesn't really save me any money.
Awesome. Any other specific questions in the crowd?
Yeah.
For sellers specifically, tax recap for people that have depreciated in like 20 years, long-time owners, is there a value as the broker to have a conversation with them, to have a conversation with you to save on taxes once they do so?
I mean, I would just tell them to 1031 and don't pay any tax. Right? I
So
mean,
can we dive into that real quick?
I mean-
What's a 1031? How does it work?
Like, buying just a personal home. This is the only asset they've had. They don't want to continue being a landlord. They're retiring.
well, they got to pay the tax then. I mean, there's really no, this is a rental property.
Rent property. 20 units. She's owned it for 20.
Yeah, I mean, when you make a lot of money, you got to pay tax, even though people hate that. It's like, well, you made a ton of money, so you have to pay some tax. And that's usually a good thing. And the way to avoid it would be 1031ing. And if we
Yeah,
want to
can we
talk
dive
about
in?
that.
What is a 1031? What do those numbers mean? How does it work?
You tax free or after the previous depreciation that they didn't use it for, like accelerated.
Can you, I don't understand the question.
So they never depreciated the property. They they recapture some of that on the?
Why would they have not depreciated the property?
Their land, their self-managed land.
Hmm.
They don't even have land.
So
Yeah, but I mean, that's
could they?
the
do-
whole reason. I mean, most people own real estate is to get the depreciation deduction because it offsets a bunch of the income.
Yeah.
So I'm surprised. So then they don't have any depreciation to recapture in that case. If there's no depreciation, there's nothing to recapture. If I'm understanding what you're saying correctly, it'd be very rare, I would think, that somebody wouldn't depreciate a property because that's the whole, one of the big reasons why we own real estate. Go ahead.
Can you confirm that? I was under the impression that even if you don't depreciate, the IRS will assume you did. And even if you hadn't taken deductions, you're gonna have to recapture as much as you could have.
There's nothing to recapture though.
Hmm.
I don't know, what would you be recapturing? You didn't capture anything.
I understand that.
Yeah, I don't know 100% because I'm not a tax guy, but like, I've literally don't know why you would ever buy a piece of real estate and not do depreciation because it offsets the money. You know what I mean? You're just paying taxes because it doesn't make sense.
Yeah, so we can double check.
I don't know who their tax advisor is, but that doesn't make sense. Yeah, I would not work with that person. And I'm just saying that tongue in cheek, but you know what I mean?
Well, can we talk, so 1031 exchange got brought up. Can we talk about when someone use it, what it means, and what are the kind of advantages and disadvantages of them?
Yeah, so if you buy a $1 million piece of property, and let's just say 20% is land, that's generally speaking, so then 800 grand of it is depreciable. And let's just say it's depreciated over 40 years. So you own it for 10 years, you're going to take 800 grand divided by 40, whatever that is, and take that every single year. So it's depreciation deduction. So if the building made 100 grand, if you've got 20 grand of depreciation, it really made 80. So you're only paying taxes on 80. So as you depreciate it, you get those deductions throughout the life. But then now the book value of the property, if it was $1 million, now it's $1,080,000 or 980,000 because you're taking those depreciation deductions. So when you go to sell, that's what these guys were asking about was the recapture. So you depreciated the asset down. So now you've got your basis is down here. You sell it for up here, you've got to recapture all this depreciation. And if you sell it for more, hopefully than you paid, you've got a large gain. And so you've got two options. You can either pocket the cash and pay the taxes on the gain, or you can do this section of the code called 1031, which is when you sell, instead of pocketing the cash, you place the cash with a 1031 transfer agent. You actually never get the cash. Like the title company sends it to this transfer agent and you need to buy another deal in 6 months and redeploy that cash. And as long as you redeploy that cash, you pay zero tax.
It's 6 months, but you have 6 months. to go.
You have 3 months. I think the rule is you have 3 months to identify the asset. You have 90 days to like put something under contract, and then you got another 90 days to close.
So what would happen if you could find a?
Then you got to pay the tax.
Okay.
Yeah, yeah. The whole point is just they want people to just keep trading and trading and trading.
Yeah. The government's basically incentivizing us to redeploy our capital into real
Well,
estate.
because they want people investing. So that's what they always say. The IRS tax code, they design it in ways to incent people to do things. They want us to buy real estate because they're giving us all these depreciation deductions. And they want us to keep redeploying it because they want us to keep investing in neighborhoods and infrastructure. And I'm actually trying to sell a building right now. And now we're not under contract, but we got to figure it out because we're going to 1031 it. Because if I don't, I'm going to have to pay a huge, because I've got all these depreciation deductions for the last 5 years. But the thing, I'll go there, but I'll just say the gain, even when you 1031, like your tax accountant will have this thing called deferred gain. So like you can just keep doing it and keep deferring these gains. But at some point, if you give it to your son or your daughter and they're like, I'm selling it. Well, I guess that brings up a different point. When you die, actually the basis steps up and there's you get to eliminate all that recapture. There's a lot of Democrats and people out there that don't like that rule and they were trying to change that recently. But generally speaking, that gain stays with you. So you can just keep trading forever, which is why people love real estate. Die, give it to your kid, and now the basis steps up and they don't have to pay any of that recapture. But if you decide to sell it when you're still living, you're going to have to pay that gain. But again, you've made a lot of money. So,
So it's like a savings account with your cash back estimate.
Yeah, exactly. But it's just a great way to just keep trading into, it's like the monopoly for greenhouses, a hotel and a couple hotels, and all of a sudden you're an empire.
Yeah, and I think there's a couple limitations on 1031. I just completed mine yesterday. Super excited. I know. I think you have to have held the property for over a year.
Oh, yeah, you do. I didn't
Which
say
is
that.
why like a lot of like flippers, like they won't 1031. If you have a flip that's gone bad, you can definitely, yeah, that's what I was looking for. Me and Dave were talking earlier about flips that have gone bad. And so if it went bad, you could do a 1031 exchange if it took over a year.
Actually, I don't think that's actually true because
Oh.
it's really about the intent. Like you're in the business of flipping. You're not intending to just hold this thing as like, if you actually ever got audited, I think they would call bullshit on that
Okay.
and would probably penalize you for that.
Okay, well then strike that idea. But
I just tell you, I've done flips that took longer than a year and we didn't get capital gains.
I think it was to, because I dealt with a client right now. From the time of closing, they're like 45 days to three properties.
Mhm.
So like you have to put those under the contract, you have to at least report properties that are, for the 231 exchange that potentially would put on. So.
Yeah.
another kind of situation.
Yeah, so basically you have to identify 3 properties. So basically the way it worked for me is I sent in the 3 addresses to my intermediary, and then once you've selected them, you just have to hopefully close on one of them. Otherwise, you're paying some capital gains.
Right.
So do you have to put in a actual like offer for those properties, or those just like properties that you are interested
As long as it's identified,
in?
you don't necessarily have to have it under contract, but you do have to close within that. I think it's 120-day time frame.
So what happens if all 3 of those properties get wiped out, like other buyers buy those properties, you can buy something else?
No,
No, you can't, it has to be one of those 3.
yeah,
really?
within that time frame, because you can't re-identify another.
So the best way to do it is probably have all your ducks in line, pretty much just the property you want before you end up, it's tough in the state of the market, but if you can do that, it's probably the most ideal situation.
Or at least once you go under contract, you better be ready to. I'm actually thinking about what I'm going to do right now. I didn't even know about this 3 thing.
Yeah, there's 3 that you have.
So there's
to
rules that I don't
identify.
even know, but
Same with
it's all
of us.
about, there's, if you think about it, the IRS is just going to require a bunch of documentation. And that's why you work with one of these transfer agents, because they know all the forms that need to be filed. They're going to tell you, hey, I need the 3 addresses. You can't ever hold the cash, so they have to possess the cash, right? Like you never got,
Yeah, never got.
you
the
got to,
cash.
you never got the cash. Yeah.
I guess I got one more on top of that. So what happens if those 3 properties do get wiped out, you can't buy those properties, and you just have to sell your property, you can't 1031 it, you have to pay capital gains tax?
I mean,
That sounds weird. It sounds weird to me that you couldn't, as long as the whole point is just buy another place within 6 months and you can't use that cash for something else and keep redeploying it.
Right.
So I would have to,
yeah,
Doesn't
I can double
feel
check,
right.
But yeah, I know you have to identify 3 for sure. Yeah.
Practically speaking, how did you deal with identifying 3, getting someone under contract? Were you having conversations with these 3 property owners simultaneously?
Yeah, so the question just was like practically how to identify which properties I was going to select.
And then manage the whole process before you actually put in an offer, or did you put offers simultaneously?
Yeah, so yeah, for me, I knew I was going to do a 1031 exchange because we built a ground up single family house not far from here. And so from the beginning, I was planning on doing a 1031 exchange. So when it got close down to the end, even before we even closed, like I started identifying properties. And I don't know if I actually wrote any offers, but we were writing offers on a pretty regular basis. And for me, I'm a mindset person, and I had very much certainty that like it was going to happen, that we'd find the right property. And I think that's, for me at least, a lot of how life works is when we're certain about something, when we have our mindset on something, like it's going to happen because we're going to figure out how to make it happen. For me, we made, I want to say 2 or 3 offers, and then I had a friend in the Berwyn-Cicero area, John Warren, awesome guy, had a old seller who was getting ready to sell again. So we found it off market.
so that's the deal you just closed on?
Yeah.
You
but-
think you closed on?
Yeah, we closed yesterday, knock on wood. But yeah, like we gave him full asking price and didn't think twice about it because it was a good deal. And for me, I think it's about getting into their mindset of knowing something's going to happen, and then just starting to write offers. Not being worried. Like if you can always get out of offers. So, don't be afraid to write them. Like even, throwing 1031 out the door, like me, I'm about writing lots of offers and seeing what works because, everyone else who's not writing offers is never going to know what happens.
Yeah, there's a question right there.
Good question. So in that scenario, say your gain is more than what you would be investing into the loan fee, would you pay taxes on the difference? Or how does that work?
What is the fact pattern that you're saying?
So say, Jonathan's example, say you have a profit of 100K on the sale, and you're gonna roll over all the proceeds, but the proceeds that you have to roll over are more than what is required to buy the next property. Would you pay taxes on the difference?
You do.
Yes.
You do.
So
I would, in that case, just take a smaller loan and just say, I'm putting this all as equity so I don't have to pay tax. If I would personally probably.
But so the question was just basically if I have $100,000 and my gain was actually 150, would I have to pay gains or pay taxes on the other 50 that I didn't deploy to that property? The answer was yes. But additionally, you can also 1031 into multiple different properties. So if you've selected 2 or 3 properties, you can roll it into 2 or 3 different properties as well. So if one property wasn't enough, didn't get you the 150,000, maybe you buy one that's a down
Right.
payment of 100 and another one that's a down payment of 50, so that you're using that full gain.
Yeah, that's a good point. A really good point. Yep.
So I'm not sure if this is answered already, but if you are selling 2 properties at once, do the profits go into the same 1031 or are they different 1031s?
I don't know.
It would be different. I only know just because I went through it, because that basically that 1031 becomes like its own like entity, right? So you can only put that into that one deal into the next deal. You can't like combine, I sold 2 properties, I'm gonna combine it to 50 and 50 to do $100,000 payment. You'd have to do it separately.
Okay, so each transaction is its own 1031. Okay.
Correct. I have some other questions too, about bookkeeping. I know you guys are huge in bookkeeping at realestateaccounting.co. So as a newer real estate investor, like when's the right time to go to bookkeeper? What software would you recommend that isn't like breaking the bank to get started? And then when's the right time to scale into something a little bit bigger?
Yeah. I use QuickBooks, still use QuickBooks for my developments. It's not property management software, but it's good for, I think you should do accounting from day one. But I really mean that. Like, I don't know how else you keep track of everything.
Yeah.
Most important thing is just open a business bank account and open a business credit card, and don't be running business stuff through your personal cards, because that's where accounting gets hard. But there's all sorts of, there's FreshBooks now, there's Wave, there's all these other softwares that have come out that I just haven't used, but QuickBooks would be the number one. And I think, outsourcing, if I just go back to my company aside, right? When I go back to my own situation, I was, leading finance at this tech company, and I was trying to flip properties and trying to have a relationship with my wife, right? There's only so many hours in the day. And so I outsourced my books because I can do that, but I didn't want to sit there nights and Saturdays and Sundays and reconciling my bank account, So at some point it's just, there's that old adage, which is just like outsource the stuff that others can do and just focus on making money and driving revenue. So at some point, when you're getting big enough and you have some budget, like I would do it yourself in the beginning because you don't have any profits. But like once you get busy enough, pay somebody to do it, because you're going to pay them a hell of a lot less than one wholesale deal is 5, 10, 30 grand if you get the right deal.
Yeah.
And you're paying a bookkeeper a couple $100 a month. I mean, so I think it becomes time. And if you have zero, like you're like, I can't do accounting at all, just, you can hire it out from day one, but I'd probably do it yourself, get used to it, see what the flow is. You usually can manage things better when you've done it yourself a little bit anyways. It's like any process of any business, I would say.
Yeah, I feel the same way. I know for me on the business side of stuff, I wish I would have started doing bookkeeping earlier because there was a mess, but it just takes so much more time to get it situated after the fact.
Yep.
When you're migrating stuff over, we actually started at Quality Builders, at least we started with Zero. Then we found out the project management software we used and it didn't talk both ways with Zero. So then we had to switch to QuickBooks. In the whole process, it just took way longer than it should have. And then, of course, we filed our taxes late for 2020, and then we had to pay some interest and some fees. So it's just like having gotten ahead of that and just said, hey, we're going to get a bookkeeper from the get-go would have been definitely a game changer for us.
Right. And I'll just say one more thing. QuickBooks for flipping. And then if you're actually self-managing, like you're charging rent, at some point you have to invest in property management software. And I'm kind of dealing with the same situation right now because I don't know if you've heard of Avail, but it's actually a Chicago startup that got acquired by Realtor.com. But it's actually great for small landlords, like 0 to, I would say, 20 units or so. They do a great job of blasting it out on every apartment site. So you say, hey, I want to list it, and it goes on like 20 different sites, Zillow, apartments.com, you name it. But they don't actually have an accounting system, but it makes it nice rent collection. People can all pay ACH. You can go in and see at some point you're going to outgrow that. And then you need to sign up for a Buildium Appfolio, which is 50 units. They're kind of the market leader. And if you get really big, then you'd invest in like a Yardi. But these things are way more expensive than QuickBooks. But you need something like that. If you're scaling, then you're big and you're making a lot of profit. And at that point, you got to invest in a good system.
Yeah, I think it's always easier to implement systems before you need them. Is one of the things I've learned is like,
point.
if you're going to be a property manager, start acting like a property manager before you're a property manager. And if you're going to be a real estate investor, like do the things that real estate investors are doing.
Yeah, it's a great point.
And start doing them before everyone else is, because then you're able to scale and grow like that much faster.
Now, this could be like more of like a broad question for in a sense, but how do you know when it's the right time to expand? Like, how do you know when your system is bulletproof? It may not always be bulletproof, but how do you know when it's like the right time to just say, you know what, let's just go.
Well, I would say for me, I'll just go to my accounting business. I don't know if this is a real estate question, but I think it could be applicable to anything, which is in the beginning, we're like, I have no idea if this is going to work, but we each put $5,000 into a bank account and we're like, let's build a website and buy some Google ads and see if we get some leads. And we just started getting leads and lots of leads. And then it was like, wow. And then we started hiring team members, and the cost of the team member was less than the revenue. And so we can actually see predictably that we're making money. And now we're getting enough leads that every dollar we put into Google is coming back and a lot more in revenue, right? And once you actually see something that's working, invest against it. But that could be with real estate, like, hey, you do a direct mail campaign and like you get a few calls back. Okay, that's actually working. Do it. I personally would have a success, find something that works, and then invest again at that thing that worked.
Yeah,
That's what my sense is, but I don't know what you'd say to that.
No, I mean, that reminds me of a book I read, Lean Startup. And it's talking about like small batches and do things in small chunks, make sure it works, and then repeat it over again. I think it's like the build, measure, learn cycle. And so, I mean, for me, it's always, I'm always wanting to go bigger, faster, just like all of us, I think, who are in the room. I feel like that's a natural sense that we're trying to do. So I'm naturally someone who's always pushing, trying to grow quicker and faster. I think, like to your point, like sometimes you'll get to the point where your process or system is outgrowing your software or something like that. So I think like, you know, at least for myself, you know, when I feel like it's a time to grow and expand is usually when I feel like the most pressure built up. You know, when things aren't going as well, is actually a time to grow bigger and get bigger, not like curl down and be worried about it, but to take that as a sign that like things are going well and I need to lean into this to go faster, not do the opposite. But that's just me. Like I'm always kind of trying to think about my mindset and where I'm going and what I'm doing. And then just making sure, like you said, if it's working, like throw gas on the fire and let it burn. Any other last minute questions? We're getting pretty close to time. I covered most of the stuff I wanted to. Anyone else have some last minute selfish question they want to ask?
I'm
about the situations where you can deduct travel expenses. And I understand if you confirm that if I'm traveling to a new market and I record all those expenses, I won't be able to deduct those until I get a property in that new market. And I think I could capitalize that. Does that sound right?
I would deduct them.
Even if you didn't buy a property?
You were trying.
Yeah, so the question just was basically if you're flying to San Antonio to look at apartment complex, but you didn't close on it, should you deduct those as a write-off?
That's the question.
Oh, yeah.
Yeah,
for
I
sure.
would. I always just think of like the government gives you very favorable business or deductions when you're a business owner. They want people to be business owners. And that's why then you get to start writing off your car and all these other different things. Now, technically, I think what the code would say is if you flew to San Antonio and it was partly like pleasure and partly business, then maybe only deduct 50% of it or 75% of it. But if you're literally going to look at deals and you don't buy a deal, like it's a business, what is it? That's a business expense. I would write that off for sure.
I thought there's a special rule that you cannot do that until you buy a property. But
I'm not aware of that rule. I would expense it personally.
I would too. Once you'll be, by the time you're big enough, you won't get caught.
You have to have it associated with one of your properties though, right? Because you're writing off against a certain income. If your different properties are different LLCs, you have to associate that expense with one of those Schedule Cs.
I suppose
or Schedule E.
I still would expense that for sure.
Yeah, or could you just not expense it against the property, but against the business, right?
I'm under the impression as long as that, you are traveling on behalf of your LLC or your business or your corporation, then anything that you do on that behalf should be a right. Making a phone call, having a business meeting, you have to travel to a different location, you're going to look at that property, as long as you're going to look at that property or do those things underneath your business focus, then it's a right.
Cool. Anything else? Awesome. Well, we got like 10 more minutes left to talk. Mark, thanks a bunch. If anyone wants to find out more about realestateaccounting.co, I assume they can go to the website www.realestateaccounting.co.
Yeah.
And you can learn more about what Mark's doing. Any other good way they can get in touch with you if they have any more questions?
LinkedIn, hit me on that. And maybe you can blast out my information too.
Yeah.
And I think it was in
It was
the
all on the
invite.
meetup and everything.
Yeah.
So, awesome.
Stay for a while too if anybody wants to chat.
Awesome. Thanks for coming.
Cool.
And thanks everyone who joined us here in person and online.